In 2025, public companies operating as crypto custodians, so-called digital asset treasuries, attracted more than $15 billion in new capital to purchase cryptocurrency. According to Bloomberg, this trend is driven by a network of Princeton alumni, which journalists have vividly dubbed the Princeton Mafia. It includes Mike Novogratz, head of Galaxy Digital, Dan Morehead, manager of Pantera Capital, and Joe Lubin, co-founder of Ethereum and head of Consensys. Novogratz and Lubin were roommates at Princeton, while Morehead lived nearby. These long-standing personal connections became the foundation for trust and joint action in the crypto industry. Mike Novogratz is a former top executive at Goldman Sachs and the Fortress Hedge Fund, and one of the most well-known institutional investors in cryptocurrencies. His company, Galaxy Digital, is engaged in trading, asset management, blockchain infrastructure, and direct investments in startups. Dan Morehead is the founder and manager of Pantera Capital, one of the first major crypto funds that began investing in Bitcoin and blockchain projects as early as the early 2010s. Joe Lubin is one of the co-founders of Ethereum, as well as the creator and head of Consensys, an ecosystem giant developing infrastructure for Ethereum, including MetaMask and Infura. What unites them is not only their university background, but also their strategic vision for the development of digital assets. A digital asset treasury refers to public companies that raise money from investors through issuing shares, bonds, and other instruments, and then use these funds to purchase Bitcoin, Ethereum, and other digital assets, holding them on their balance sheets.
Next, Mike, I want to bring you into the conversation since Tim mentioned that about 85 companies are involved in DATs, and you said that you don't believe all these DATs will be successful. But if a critical mass is reached, the yield of the underlying token is increased, and an ecosystem is built, I think overall it's positive for cryptocurrency. These are public companies that will exist for a long time. Mike, what will determine success and longevity?
Yes. Listen, I think you'll need scale, right? Because scale begets scale. And so, for example, you think about a company like MicroStrategy, which was the first to enter. Now it has a strategy, it has scale. Then, what are these companies probably doing? They bring energy into the ecosystem in several different ways. And what I was initially a bit mistaken about, but then later realized, is that access to capital through the stock infrastructure is actually much greater and more significant than it was through the crypto infrastructure, right? The crypto business is only 12 years old, while stocks have been around for a very, very long time. The remarkable thing about these data center and treasury companies is that they've attracted much more capital in a short period of time. And it's this capital that will build the industry.
This approach allows you to benefit from the growth of cryptocurrency while remaining within the familiar corporate structure. It's a kind of institutional way to buy cryptocurrencies, where private investors purchase company shares and indirectly own digital assets. This is an experimental model that combines traditional treasury management with new digital assets, and it carries increased risks, price volatility, regulatory pressure, and market reaction. The funds managed by Novogratz, Morehead, and Lubin are actively involved in key deals with DAT companies. Joe Lubin heads SharpLink, while Mike Novogratz and Dan Morehead have invested in Bitmain and a number of other projects. Pantera has backed a new Solana-based company called Helios, while Galaxy Digital has invested in its competitor, Forward Industries. Bloomberg notes that about a third of all digital asset treasury deals involve the same funds. Sometimes, new competing projects are launched just a few days apart, simply because the participants didn't have time to coordinate a call. This creates the effect of a tightly knit network, where a handful of influential players are able to direct significant capital flows into the same sectors. These examples show that participation in DEFI is not about passively holding cryptocurrency, but rather an active strategy of launching and managing projects. SharpLink, led by Lubin, announced plans to hold a significant amount of Ethereum on its balance sheet. But after it declared a stock sale, its share price dropped by nearly 72% in a single day. Bitmain is another example. The company is engaged in cryptocurrency mining and building reserves, attracting investors' money and then converting it into digital assets. Helios is building infrastructure on Solana, while Forward Industries is a competing startup with similar goals. All of these projects involve the same funds, creating an informal ecosystem within the digital asset treasury market.
I think that in each of these areas, I really like that Mark is launching another company based on Solana, because it's also located in another part of the world. This will help attract a different circle of new investors. Forward Industries is a company and investor base primarily focused on the US. But this is a global technology. So in a way, the more the better. I think that in order to survive, you'll have to prove to investors that you bring value. If we trade at net asset value, it will be difficult to attract more capital. You need to do something that will make you think. We have $1.6 billion in Solana. By staking, we increased the yield from 7% to 10%. This will bring in $160 million in dividends. These $160 million can be used for other interesting things. You can use this advantage to perhaps get a good deal and a free stake in a program being built on top of the blockchain. That's why you need to be creative.
The digital asset treasury market is growing rapidly, but it remains vulnerable. Companies have already announced plans to invest tens of billions of dollars in cryptocurrencies. At the same time, regulators are still in the process of developing their approach. If most tokens are not classified as securities, the DAT model could go mainstream. If, on the contrary, it has to adapt to new requirements. The concentration of capital and influence in the hands of a limited group of investors raises questions about transparency and competition. As the market grows, this network can accelerate infrastructure development and give a boost to new companies. During a downturn, it can intensify the crisis. If the same players are forced to sell off assets simultaneously, it could create a domino effect. There are several possible development scenarios. With steady growth in cryptocurrencies, the DATI model could become mainstream and turn into the standard for institutional investment in digital assets. With increased regulation, it could shrink and become a niche, available only to the largest and most transparent players. In the event of a deep downturn in the cryptocurrency market, many DATI companies may be forced to sell off assets, which would intensify the decline and create a new wave of distrust toward institutional crypto structures. The future of digital asset treasury depends on the cryptocurrency market, on regulators, and on the ability of participants to adapt. The Princeton Mafia is not a mafia in the literal sense, but rather a network of influential investors with university ties who have become the driving force behind a new phenomenon. Their story shows how personal connections, trust, and shared values can transform an entire industry. Keep an eye on these movements if you're interested in the institutional side of cryptocurrencies. This could be both a new step toward the legalization and integration of digital assets into the economy, as well as a source of systemic risks. Share your opinion. Which scenario for the development of digital asset treasury do you consider most likely? Rapid growth, regulation, or crisis?